Thanks for joining me. Happy New Year. Here's our quarterly update with our Winthrop portfolio managers, Adam Coons and Greg Hahn. Thank you so much for joining me. So we've had such a crazy year last year. Let's look forward to this year. I'll just run down my list of questions here. How have the recent high inflation and low returns in the equity and fixed income markets impacted the portfolios?
Let me start and then turn it over to Adam. But the where we've come in at the beginning of 2022 all the way through the end of the year was a readjustment in valuations. And whenever the market's readjusting valuations, it impacts total return. So returns both in the equity market and the fixed income market were challenged because of the revaluation in the marketplace last year. It's a tough year.
Yeah, so I think just to expand upon that, it really with interest rates and inflation driving interest rates up, long duration strategies underperform. So what I mean by that is in the bond market, long duration would be longer maturity bonds underperformed, and then on the equity side, growth underperformed, which you would view those cash flows as being a longer duration. So it was no surprise that those two segments of the market greatly underperformed either shorter duration fixed income or value on the equity side.
And so in my next question, do you anticipate any pivot in Fed policy or rates?
Well, I think the Fed has been pretty clear that inflation's the number one priority, and they will continue to push short-term interest rates higher. The question is at what pace? And I think that we're more in the camp that they're going to settle down into more of a 25 basis point cadence instead of a 75 basis point every meeting. So what we're looking at is the forward rate of inflation, which I think is around 4 to 4.5%, should start to match short-term interest rates. Will probably push a little bit higher, but that's really the tipping point for when the Fed can start to really slow down and pause.
How do you expect the asset allocation and portfolio models to shift during the first quarter?
Yeah, so I in going through the sector models, to be specific there, we're maintaining our overweight to technology. We are moving to equal weight on financials, and then moving to overweight on industrials. A large part that's driven by the thesis that we do see long-term interest rates coming down, primarily driven by inflation falling. And then with that, in the fixed income allocation, we have extended duration. We continue to do that incrementally like I said, that's buying longer maturity bonds, longer maturity fixed income ETFs. And then with that, increasing our allocation to growth as well. So not a big shift in the overall allocation to equity or fixed income, but within those two components, moving the deck chairs around a little bit to take advantage of lower interest rates.
Do you anticipate any changes in consumer spending this quarter?
That's a good question. Our feeling is the U.S. economy is slowing, the global economy is slowing. With that, a key issue is going to be consumption, but the labor market is really, really strong right now. Even though we're seeing some headlines in the technology sector where we're seeing layoffs, the labor market unemployment is still 3.7%. We saw phenomenal job growth last year, and if people feel good about their jobs, they're going to keep spending. So marginally, we may see some pressure. It was a tough holiday shopping season, but I think the consumer still has some money to spend. So at the margin, I'd probably see a little bit of slowdown, but it's not going to be the collapse we saw in 2009.
And where do you see opportunities for investors to grow their portfolios in 2023?
So I think to reiterate what the shifts we're making in the portfolios, first in the fixed income component, I do think a longer duration strategy, when you look at the risk are asymmetric with a higher likelihood of interest rates falling than going much higher. So we do see opportunity in the fixed income markets. We're able to fund portfolios near 6% still with credit spreads wider, and a municipal portfolio with a 4% interest rates. So in the fixed income market, we do still see many opportunities. And then the equity market, I mean, we are still cautious. There are a lot of headwinds, but we're really focused on valuations, and valuations did reset a bit. But if you look at the underlying components of the market, valuations really stayed about the same for value stocks. Where they got cheaper were in growth stocks. So that's an area that we're looking at. I think there are more opportunities there. In particular, if you do see interest rates come down, like Greg said, a lower interest rate helps support a higher valuation, which would help support stocks like technology stocks or some of your medical device stocks.
And Courtney, another area, we're still constructive in the healthcare sector. In the industrial sector, the backlog is still very strong. So industrials is a big part of our allocation, particularly in the defense sector. Unfortunately, we got a war in the Ukraine, and so there's a strong need, both because of what's going on in the South China Sea as well as in Europe, for increase in defense spending, and that's, I think, constructive for the market. And where we've got some concern and a lot of dialogue is around the communications services sector and some consolidation in the streaming space. And that's an area that had some real mixed results last year.
How about energy? What do you think about the energy sector?
I think it plays into the same theme. As if you look at inflation falling and you see consumer spending even just tapering off, it doesn't have to fall off a cliff. You will see energy prices come down. And so that's really been what's propped up the energy sector over 2022. And if you look at 2023, there's just not the catalyst for energy prices to go higher, which would result in, a lack of catalyst for energy stocks.
Well, and China is a big part of this too, is that if China in a post-COVID world, the economy starts to get some traction, their demand for energy is going to increase. So marginally, we'll see more flow into China, and that'll increase demand. And then U.S. policy, if we do see increase in shale production, that'll help put more supply in the market as well.
So I've got one last question for you guys. Okay, predicting the S&P 500. Where's it going to close at the end of 2023? I'm going to write it down.
That's a good question. Adam, you go first.
Oh boy. I would say, I'm going to give you a range to kind of cop out, but I would say we end unchanged to 4,200. So between 4,000 and 4,200 would be my...
And I actually was in the same place, but I'll come at it a little bit different. As if we look at earnings, earnings in that 180 to 200 area, and you put if we see some support in the current multiple, and that would be in the forward multiple somewhere around 16, 17, 18 in that area, I think we could support a 4,200 on the S&P.
4,200, got it. Okay.
And I will say, just because, even with the thought that the S&P 500 might not move a lot, I do think this will continue to be a stock picker's market where there will be plenty of stocks that do well, even if the overall index hasn't changed as much.
When we started the year, there were 5 stocks that made up over 25% of the index, including Meta, and Tesla was number 6. And those 2 stocks today are a fraction of what they were at the beginning of last year. So we've seen changes in the leadership of the S&P 500. And that actually is a good thing, because it takes that concentration risk out of the index and really makes it more of a broad market index.
Okay, great. I appreciate your update. And thanks for looking out for our clients' portfolios. And
Absolutely.
Really appreciate it. Thank you.
Yep. Thank you, Courtney.